For decades on Wall Street, they used to say, and in the City of London, sell in May and go away. Those were the days. Because at this time of the year, traders will be getting ready for a summer in the Berkshires or the Hamptons, going off to the Borscht Belt. And the idea was that you sold the stocks that generally lagged between June and September because markets were so quiet. It might be tempting after the Nasdaq just posted its best month since 2020. Analysts at Deutsche Bank are not so sure. They advise against it based on historical data of European stocks. Apparently, it's a bad idea because look, Sam Stovall is the chief investment strategist at CFRA Research. You and I both grew up with that mantra, sell in May, go away. I don't know anybody who ever actually did it, but everybody said somebody else should.
Well, Richard, yes, everybody talks about it because historically, from World War II, the May through October period gained only about 2% for the overall market, but up 7% from November through April. And so at least it's something that sounds interesting, and it advises investors don't let your emotions rule your portfolio's action. Just be aware that there could be volatility in these coming 6 months.
So if there's no real justification for the old idea of sell in May, go away, the problem is, A, if you're selling stocks now at higher levels to the capital gains tax issue in many cases that you've got, particularly if you look at it, Nvidia and those big ones. And secondly, what do you do with the money instead? Now, that's a stupid question at one level. You put into cash, you put into the bonds, whatever. You park it somewhere. But then you're going to have the uncomfortableness of just watching the market go up and up and up.
Well, you're right. And also, really, it's only the midterm election year of the 4-year presidential cycle in which the sell in May adage actually works, because in that period since 1990, the S&P lost 1.5% on average, and also fell more frequently than it advanced. So typically investors rotated into the defensive areas of food, beverage, tobacco, and healthcare as they waited out this volatility, but then dived back into the more cyclical sectors like tech come the beginning of November.
Do you think that's a strategy worth following today?
I think it's something that for nervous investors could be a good way of staying in the market, in a sense, rotating rather than retreating. But this technique has not really worked over the last 6 or 7 years,
Okay.
mainly because technology has just driven the markets so dramatically.
So a question I'm asking sort of most of our people like yourself who know what they're talking about, before we went into the war, there was a definite, obviously, story and feeling that the market was overvalued, the AI hype, etc., etc. That, to some extent, has abated as we've got numbers. But the truth is that the market is still tech AI dominated, and that could still be regarded as precarious. Or am I being old-fashioned and somewhat backward?
No, I think you're right that investors are concerned because valuations do matter, whether it's technology stocks or any other stocks on the market. And prior to the recent sell-off, the tech stocks were trading at a 20% premium to their 5-year average valuation. And today, they're still around a 9%, 10% discount. So some investors would say that there is upside momentum ahead.
I'm good to see you, sir. Thank you very much indeed for joining us.